And good afternoon and good evening. It's no longer good morning because I live in San Francisco on the West Coast. Unless you're in Hawaii, then it is good morning. Um, Good afternoon and good evening. My name is Michael Filighera. I am the chief cook and bottle washer, so to speak, at Traders Helping Traders and Logical Signals, both.com. And a little bit of history on myself. I have been in the market since 1979. I originally came on as an options market maker, and I've traded as that here in San Francisco on the Pacific Exchange and on the London Traded Options Market and on the European Options Exchange in Amsterdam, and then also on the DTB, which is in Germany. And on the DTB is where I got my first introduction into all electronic trading. And it was quite eye-opening, and to say the least. I spent 10 years in Amsterdam, came back to the US, went back down to the Pacific Exchange, and was really great. Kind of came up right into that peak and almost the breakdown or of the dot-com bubble bursting. And so but after that happened and we nosedived into a low, the market really started to dry up because it was going all electronic. So everything was being done electronically, and orders are being routed to different exchanges. So things got to be very slow. And I left the floor. I decided that it was just not going to be worthwhile to stand on the floor all day and not really do anything. So I set up in my home and continued to trade options, but found out that I realized that I was not getting along with volatility that was more intraday. And so I decided that I wanted to come up with a better tactic of how I wanted to trade. And that is how I became a day trader. Um, as a day trader, you're not carrying any overnight risk. And so to have to carry options positions, I no longer needed to do that. And so I just switched my method, my mode, and then also just had to add some additional indicators. But since the title of this today is My Favorite Indicators, they remain the same for my entire career, basically, they have all remained the same. And they are Elliott wave, so the Elliott wave principle, and Fibonacci, the number sequences and the Fibonacci levels that you can add to any chart. Now, I learned Elliott wave from Robert Prechter and Dan Ascani. Those were my two teachers in the beginning. And I learned in late 1988, began to employ it immediately in 1989. And I was already located in Amsterdam, and I was already trading on the European Options Exchange. So I started to really chart and build my charts on the European Options Exchange index. And so what kind of came out of all of that is I began to trade and I began to set up my positions according to what the Elliott wave was telling me. Now, again, back then, there weren't a lot of the influences, i.e. the big one being algorithms. Algorithms have come into play much later in all of this sequence. So the whole premise of Elliott wave is that it's actually measuring, which are chartable, human emotional reactions. So we're dealing with how you and I might react to a number, to a disaster, to something that happens within the marketplace. And at the time when this was really beneficial for me, this was in 1990, and the market at the beginning of the year and all the way up until August was just slow and very range bound and very, not very productive. And then suddenly Saddam Hussein invaded Kuwait. And of course, that was, a surprise to the globe and to all the markets. And everybody started to nosedive because, crude oil went through the roof. But what came before that was that my Elliott wave count was basically very indicating that there was going to be a strong or a large correction beginning. And so what I kept doing, because of course timing is everything, I ended up basically just buying a lot of puts and positioning via puts and putting things on, selling calls and buying puts. And and eventually, when it all started, he happened to be the only one that actually had the puts long. And so it became very profitable. Now, the point that I'm making here is that Elliott Wave gave indications, started to give signals that the market was getting ready to correct. And that's the important thing that I carry forward, is that it's not necessarily the predictability of the market, but if you can call it that, but really what it is just analyzing human emotional responses to what was going on and what was not really happening, what we were not seeing in the marketplace. And some of those was just input call ratios into the market breadth, a lot of other indicators. But the main one that I continue to use, of course, is Elliott Wave. Now, Fibonacci comes into play because I use Fibonacci to indicate where the market may get to in a particular move, in a particular wave formation. And so this has become very helpful, by the way, with all of the markets going to new all-time highs. Never before been to areas that the market has reached. And in fact, in the NASDAQ, that level was way back here, was the all-time high back in, well, this time in the NASDAQ, it hit it in November of 2021 at 16,767. And so from that level, the market started to go down, but it was indicated because initially I knew that we're finishing five waves, but I had actually thought we were finishing five waves up, not only on intermediate degree, but I thought on a primary degree as well. And that would have then suggested that what this was completing was a cycle wave three. Now, here's the other benefit of using Elliott Wave, because all Elliotticians are taught that not only do you have a preferred count, but you have an alternate count. And why? Well, because human emotions change and how things roll out change. And so I've always been able to work with a preferred count and an alternate count. And in this case, my alternate count was that this would only be primary wave three, and that what we were unfolding in was a primary four. That was my alternate. And I carried it as my alternate for quite some time, even after breaking back above the all-time high and now moving into a new all-time territory, because there are other patterns within Elliott Wave that you can use. For example, this ended up being three waves down. And so I marked it as primary wave A. Well, when you study Elliott, you realize on this large of a degree, you're looking for B wave. Well, the B wave can come in several forms. It should also be three waves, but then again, you're looking for it to maybe on a Fibonacci basis to retrace maybe 50 to 62% of the A wave. And if it doesn't, and it ends up going to 100%, that's also acceptable. But when it starts breaking above the starting point of the A wave, it is possible, but then it falls into another label, so to speak, as it's then considered an irregular B wave. And what that suggests, no matter what direction the B wave happens to be going, it goes beyond the end point or the starting point of the A wave. In this case, once it started to get above the 16,767 level, then it became irregular. But then you use different Fibonacci. And so I had 1.236 and 1.382. That's how far the market could travel and still be considered a irregular B wave. Now, so my preferred count stayed that way until the market actually told me, nope, we're going higher. Now, I always had and was still working behind it my alternate count, which would have put that as minor wave three, and then this, instead of being primary wave three, instead of this being primary wave A, I was running it on a separate level as a primary fourth wave. So now, as a primary fourth wave, what that then suggests, and to make my point clearer, once we started getting up into new uncharted territory, so to speak, you can use Fibonacci to give you levels. And then once that level was broken at 1.382 and kept going in a strong rally, which was this section of it, you automatically can jump over to your fourth wave. It being that it was a fourth wave, that was my alternate. And now you can run your fibs accordingly. As you're marching out of that, you've got levels for your third, you've got levels up here, you've got levels coming off of an intermediate degree, and you can start to track where the market is going. Now, mind you, if I bring this down, you're going to see more cleanly what the market really has done. Let me go up one more. Let me go up to like the 4 hour. And so we go from here, and you can see that I had, well, this is different levels, but I had all the levels kind of tied up. And as the market progressed higher, we have relationships within Fibonacci that are more tuned to Elliott. For example, if I've completed waves one through 4, like saying here, this was a minute degree, I can run Fibonacci so I can get a handle on what should my, I got to go way out. I got to go all the way out to that weekly chart. I can get there's relationships between the fifth wave, which is kind of all cluttered in underneath all that, and the first wave. So you can run fibs from here to here. They're actually in the Thinkorswim platform using the extensions, fib extensions. And on most of them, they call them fib extensions and fib retracements. The extensions are you're going beyond this current wave, and retracements are what I'm looking for inside. So you can put up extensions from here over to where this 4 was, and you've got your measurements all the way up to what this minute fifth wave can look like or where it can reach. And again, we started to get extensions in here. So those levels started to go, you have your most common, and within a fifth wave, the most common relationship between wave 5 and wave 1 is that they're equal. So it's equality, which is 100%. So, but when they start going past that, we also have other methods where we can say, well, the second most common is 1.618. The third most common is 0.618, but that one can get taken out right away, right? If you're in a strong rally phase or even in a strong decline and you're trying to measure it out, and 0.618 gets reached and surpassed, well, that takes the third most common right out of the game. So now you know you're already looking for at least that 100 to 1.618 kind of going up. So the predictive quality of Fibonacci and Elliott put together starts to come into focus, but it's really just numbers. And so when one of the things that I really like about moving on with Elliott Wave and then bringing it down, because that's actually what my presentation today I want to talk about, is that how I use Elliott Wave as a day trader. And so Elliott Wave can be used very cleanly, very carefully with day trading. And at that same time, what then happens is that it allows me to bring in other technical indicators that help to supply backing or just additional information about what is this market doing and where can it go. But at its heart, I'm continuing to use Fibonacci and Elliott. Let me go back to the hourly chart so I can show you pretty much. So there we have the high. And at that high, in my view, it finished a sub minuet wave 5, a minuet fifth wave, a minute fifth wave, and a minor third wave. So in the bigger scope, in the bigger picture, both in the NASDAQ and in the S&P, the market's completed a minor third wave. So what am I tracking out? I'm tracking out a minor fourth wave decline. So if you know what goes inside of that fourth wave, it's going to be a minute degree ABC. Well, what could wave A look like? It could like be 5 waves down. And in this case, I've got 1, 2, and 3 complete. And so I figure that I'm within a minuet wave 4. And now I can also line up my fibs. And what did we do? We came up today and we got right on the head. We hit the 0.382 and we backed off. So it got up there, reached that level, and you could say we saw a failure. The market failed to go back, go up and go through it, and it started going down. Now, if I bring this down to the 15-minute chart, now we see it a little bit more clearly. So what can I deduct from all of that? Well, I'm looking for an ABC up. I think I got more than just that, but a fourth wave can be a sequence of ABC. So you get an ABCX and another ABC. Okay, I got an ABC, I got an X, I got another ABC. Or actually, it's even more complex than that because of the way the market traded. But main thing is it hit a target. The most common retracement level for a fourth wave is 38.2%. Second is 50%. The rule states that being, now we have to go by color, because it was in a minuet fourth wave, is that the rule states that the market cannot go over and penetrate the price territory of the first wave of the sequence. And that is on this minuet degree, the purple. So what the market cannot do is go up and break 20,333, 20,335, excuse me. So if it went above that, it invalidates this particular count and leaves this as an ABC. Now, what does that do for you? Well, if you listen to any of my updates, which I do make daily and I post on YouTube, I give you both sides of the market. So here's something else that Elliott is able to do for you. You've got both, both views, so to speak, and you know where the break point is. So there'd be no second guessing. If it goes up and it breaks there, I would be expecting it to start to accelerate and really get itself. But I'm already going to get my first hit if it comes above 382 and then powers above 50%. So if it powered above 20,225, well, then I'm going to be looking for something different. Now, mind you, today, right, we've got Tesla and we have Google reporting, both reporting after the close. Now, both can provide a dynamic, huge run in either direction. If they come out knocking them dead with the earnings, with really strong forward guidance about where they're going to make money and where they're, where things are going to be improving, then yes, I think collectively the market can go and jump after hours 100 or more points. We've seen that done with NVIDIA all by itself. NVIDIA kind of blowing the doors off of earnings and suddenly, the market's up. But, instead of having to think, oh, you were wrong on your count and everything else, I'm already ready, so to speak. Because if the market breaks above that level, then I know it's not going down and I know I need to go up here and rechange this. Because likely what's happening is I'm not sure how I would do it, to be honest with you, because I've been pretty steady with making sure that my counts were correct in terms of, where the market is getting, because to back it out of this, that it wouldn't be, the best I could do is to put the third up there. But then guess what? I'd have to move this third. And the reason being, let me just open this up, is because this is a done deal. And this move has already gone further than the full length of that. So I can't move this third up to here and put the 4 over here. So I have to go up a degree, and that's this degree. That's the minuet degree. Now that I I'd likely have to switch and bring the third all the way up to here. And that this would be, and that's on a break, folks. Now, please understand, that's on a break above what I've marked as wave one. So that's 20,335. It has to break and keep going. Then I can put that up there. So predictive, yes. What you have as an alternate is like, well, what happens if it breaks there? Are we just left out hanging? No. That would be if you are a position trader and you have positions in the NASDAQ, or if you have positions in the SPX or in the ES or in the spiders, then yes, you're going to want that level because maybe that's where you're putting your stop. You know, if I had a longer term position on in these indexes, it would be definitely where I put my stop. If it was something that I was looking to hold on to because I felt that the market was going to drop down to here, which, by the way, that's why you see that orange box. One of the things that Elliott teaches us is that a fourth wave will find its terminus, its endpoint, within the price territory of the fourth wave of one lesser degree. Well, sitting on the top, I'm saying we're in a minor fourth wave. Well, that suggests that we're going to be dropping down in a minor fourth wave, and that should find its terminus in here, which is where the minute fourth wave takes place. And at the terminus, so at the endpoint. So I'm looking for ultimately something to get us back to 17,500. And you may think, well, that's so much that can't happen. Oh, it can happen. And there's plenty that can drive it down there. A few of the Mag 7 coming out with not so pleasing earnings will do it all by itself. What happens if Google and Tesla don't meet up to what the market is thinking they should? So as quickly as we could go up, we can go down 100. And if we go down 100, we're going to be down here. And then again, get this. Here's the good part, right? It's like everybody thinks, oh, you know, the market's got to crash, the market's got to do that. No, because here's my thought. If we're coming down in a minor fourth wave, let me open back up here. We're coming down in a minor fourth wave, and it finds its terminus point in here. We have a minor fifth wave to go back up. And that minor fifth wave would be expected to take out the high of minor 3. So that means new all-time highs again, above 21,000 most likely. Then what are we doing up there? Well, we're finishing an intermediate third wave, right? Think of Elliott wave as building blocks, right? So we have a primary fifth wave. That's the big one that's in motion. What's going to be inside of that? 5 waves of intermediate degree, of which I've got 1 and 2. And we're still within the intermediate third wave. So where are we inside that intermediate third wave? Well, we just completed minor wave 3 of intermediate wave 3. And so I'm looking for minor wave 4 of intermediate wave 3. And then a minor wave 5 of intermediate wave 3 to complete intermediate wave 3. So once it is done, I'm going to be looking for an intermediate fourth wave, which again brings us back down approximately into this area here. And then when that's done, an intermediate fifth wave takes us back up and again to new all-time highs, but even further than what we went to before. So once that is in, once intermediate wave 5 is in, then primary wave 5 is complete. Then again, I would be putting a cycle wave 3 up there. And I'd be looking for it to go into a much more lengthy, involved corrective process. Now, please remember as well, corrections, yes, they can appear like they're going straight down, as evidenced in many times. This was the dot-com bust. It actually is an ABC, although it looks like it's a 5, because the initial was 5, the A wave, and then a B, and then the C wave was 5. So that was very destructive. The high that it started off was 4,884. The low was 820, no, excuse me, 797. So it lost 87% of its value in about a year and a half, maybe 2 years. Then we started up again. So, right, we're in, right, that cycle two. So in essence, what happened to the NASDAQ back in the 2000 to 2002 was like what happened to the Dow and other, the S&P in 1929. It was the crash. This, folks, was the great financial collapse of 2008, 2009, the mortgages. Look at the difference. Now, if I take this out and I look at it on the Dow, this is like twice that. This is so big. This is the pandemic. And so we have to consider what fueled all of this. I mean, you can go into all the detail, what fueled the rallies, what fueled this rally, and what continues to fuel this rally. First of all, we got AI, right? And that's for real. So I do not doubt the power of artificial intelligence. What I do feel is that too much, too soon, too fast, and so things kind of get overvalued. Everybody's on the Nvidia bandwagon because they're the ones producing the chips that are going to make everybody else lots of money. So, but you don't get ahead of yourself. We still have corrections to do. Does not mean that Nvidia is a bad company. Does not mean that Apple's a bad company or Microsoft or any of them. It just means that they become overvalued. You can only push so hard, and they have to be supported by a continuation of now large sums of money being earned by the company. And if anything disrupts that cycle, well, then you get a correction, a readjustment. And that's all I'm looking for here is a readjustment. I'm not saying that any of these companies and any of these indexes is bad, or they don't know what they're doing, or, why would they have bad earnings? Well, because the economy changes. Well, we're going to continue to go up. Why? Because the Fed is going to lower interest rates. Well, that is a bad word to use. We don't have any guarantees. The market wants them to, and the market's now pricing it in as if it's going to happen in September. What happens if it doesn't? So again, when you're using Elliott and you have a preferred and an alternate account, it's because the market is not and does not operate on 100% certainties. They do not exist. A guarantee in the market does not exist. I think people are searching for it. That's what they want, but they don't exist. But we can really now improve how we trade if we're just making adjustments to what style do we want. We have people that just want to go and they trade options and they try to hit a home run. So they want to get in and they want to get cheap options because they think that the market can really go somewhere. Let me just show you some examples. I was looking at Tesla, and I'm going to come down here. Do you see this? These options expire on Friday. 13,138 contracts have traded today, all at a penny. It's the 420 call that expires on Friday. If you understand options, a call options gives you the right to purchase 100 shares of Tesla on or before Friday, the 26th of July at 4 o'clock Eastern. That's when it expires. That's when it dies. And for that right, you're paying 1 penny. So essentially, what are you agreeing to? You're agreeing to really buy 100 shares of Tesla at $420, but it's got to get above 420 for that to be in the money. It's trading at 248. That's somebody trying to bat a home run. I mean, I saw today, there's one trader, somebody came in and bought close to 4,000 today. So it's like, you wonder why it's trading with 130, almost 131% volatility. When you start to look here, and we're going to come down, let's go up a little bit. Let's go to the at the money. 248 is where it's trading, 248, 249. So even the 250, let's go to the 250 call, which has 29,000. That's a little bit more realistic. Oh, look what they're paying, $11.35. So essentially, what somebody's agreeing to when they say, I will buy 100 shares of Tesla at $250 a share, but I'm giving you, seller of the call, $11.40 to do it. So what are you paying for the stock? $261.40. Now, what happens when we get this and I'm a dealer in the stock and I sell that? I sell you that call at $11.40. I can go out and buy 100 shares of stock at 248, and I'm going to pocket, even if it goes to 250 by Friday, and you exercise your calls. This volatility will equate to where the stock price is versus the hope of where it could go. So again, that has a big effect on how things trade. And that's something else that I've added to my daily analysis. So I wanted to talk a little bit about how I now use this for day trading. I think it's very important to always have a style. What is it that you're looking to do? I do trade the NASDAQ future, but what I do and what I'm trading is also readily available. And I do provide the same analysis in the S&P. You could also use it in the Russell. You can use it in the Dow. You can use it in cryptos. You can use it in the bonds. You can use it in gold. You can use it in silver. So it is applicable just to any market that is humanly traded. Then you will be able to work out. And I actually already have counts in gold and silver and platinum and the S&P and individual stocks. So I do a lot of different work. But getting back to the market that I do trade, why do I advocate day trading? Because the moves in the NASDAQ are pretty incredible. And right now, what I'd like to do is to kind of switch over. So I believe I can do that if I stop this share and then I go back and I go share. And I want to go over to this particular screen, which is actually my trading screen. So now you can see my trading screen, and I'm going to switch them over here. So this is actually a 5-minute chart, a 2-minute chart, and a 15-minute chart. And so now I'm going to add my other favorite indicators, right? So we're talking about our favorite indicators. I've just discussed the Elliott and the Fibonacci. Elliott and Fibonacci are also present here, right? I can count and I can see that this is a little bit more complex, but initially really what it is 3 up. Now, either it's 1, 2, 1, 2, and we're going to continue to blast higher, which we may do. We're beginning to get, well, we are within the last hour of trade. So here's what I start to add. I'm starting to add some different things on, I'm begin to add some different products, and they are, as I have, these are marks for, this is the high, the session high. This is value area high. This is value area low. There's the point of control. And if you know what each one of those means, the point of control is where the most of the volume has taken place thus far during our session. And I have it at 19,966 there. And I have it right here in this chart at 19,964. So it's just a very slight difference, but basically in the hood. And see all those bars? That's volume. And you can see the volume is the greatest, and it's putting it there right now. And if we continue to move up and the volume increases up here, it's got a lot to go, then this would move. But right now, this is what you would call the mean. So it kind of goes up, but it maybe comes back to the mean. It goes down, it comes back to the mean. It's the point of control. That's where buyer and seller are ready and freely will trade. So what we got going on is day trading. Now, let me just say, the NASDAQ is $5 per tick. There are 4 ticks to the dollar. So the NASDAQ is $20 per point. You just saw it drop from 986 to 977 in one swoop. Figure out your dollars there, folks. So what I'm basically saying is the NASDAQ moves in big dollars. And let's say, I think actually we might, I'm just going to throw this out there. You can see how they buy it back up and they might just keep taking it, but nope. So what you try to do is I'm going to pay attention, then maybe I enter a sell order. If I'm reading the candlesticks as well, but if it starts to break severely below that, the next guess would be that it's going to come down to 976. So it's only from where it is 5 points. But then I have a trend line, which is automatically drawn, that if it breaks below, we should get some acceleration. Then I got my point of control. So again, you can feed yourself with what you think the market's going to do. Now, how do you trade? Well, you better trade easily because one contract right there, if you got in at 86 and you got out at 76, that's $10. That's $200 per contract. And so consequently, when we get these larger moves, again, these are 2-minute moves. This is a 15-minute move. And these are 5-minute moves. And so we put this all together and then I have an RSI, and this is just actually a chop indicator. So when it's kind of sitting in between here, 40 and 60, it's kind of, you would say it's choppy. Watch the price. We go up, we slide back down. We go up, we slide back down. That's chop. But there's ways to trade it. And so my other point that I want to make in day trading is I get to come in and I don't take a bullish or a bullish or bearish bias to the market. I don't care if it goes up or down. I really don't. I don't care what stock goes running in one direction and what stock goes running in another direction. They all have weighting, and I watch a great deal of them because I'm trying to determine where the market is going to really produce a stronger run, which we haven't really had today. We kind of did from our low up to the high. Yeah, that was great. But in terms of just a steady, like we've seen in the past, where the market, like yesterday in the afternoon, it just kind of tick, 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 and didn't stop. It just kept going. Well, that was due to a particular trade that a lot of firms were still participating in. And as long as you can recognize that, well, then you can sit through any of the pullbacks. But as a day trader, and you're trading a future, like that moves, it's $20 a point, and it moves in $5, $10, $15 increments quickly, well, you can see how much you can make or lose. So you have to be able to have a trading plan, so to speak. And I have a very simple one, and I'll share that with you. Number one, I identify what my trigger is going to be. And let's say, for example, right now, my trigger would be if it breaks and holds below this trend line, I'd be looking for it to continue lower before it would pop higher. But if it comes down and holds this or trips back up and gets back above it, then I think they will continue to buy it before they're going to push through more sells. Remember, I'm a day trader. And my favorite thing to do in the market is scalp. And you can go scalp $100, $200, $300. How many times can you do that in a day? Well, enough to make pretty decent P&L. Now, what's the second point? If I can figure out what my trigger is going to be, then what do I need to there? What's your target? Again, if it were to break here, my target would be at least down to 65, which is the point of control. Now, it might fly through point of control, but then I've got this other Bollinger Band-like indicator, which if it's broken, it's going to slide. If it's not, it should find its support and then bounce. It may only be a temporary bounce, but hey, it's a bounce. As a day trader, I can take advantage of that. So one of the things that we do, and I also have a trade room, and I run that together with a colleague who happens to be located over in Germany. His name is Sasha. And I'm just going to step out and say Sasha is brilliant with technical analysis. Now, again, another indicator that we're adding, we add to where resting orders are going to be or where they're sitting in the market. And they're called liquidation areas. So if you've got a bunch of sell orders, they become magnets. If we have sell orders sitting above the market, they become magnets for algorithms. If you're just going to go on a buying spree and you're just going to go, you're headed towards wherever these orders are sitting. And then maybe you're going to try to get fills up there, or it's an algorithm that's just going to go up there and try to trigger them to then push something that's above that maybe that same algorithm has got a resting order at. There's all kinds of things that go on that really don't make any difference. But if you had the knowledge of where those orders were sitting and you see the run starting and you see it go right to it, I need to find one this morning that we had a bunch, and I think it was actually right here. Yeah, it was at 46. And they went up and they tested it. And then what did it do? Whoa, dropped all the way back off. And then this was the second time, and they just beelined to get up inside where all of these resting orders were sitting between 46 and 80. That's where they all sat, stacked up, and they just started to go through them. And once they were done, look what happened. Now, good to know, and good to get that information from somebody who knows how to read it. And good to get that information from somebody that actually could tell you, it's like, okay, we're going to look for that. We're going to play it from the long side, but let's see what happens when they're done. And let's see if the market is going to reject it. And they did. Now you're a day trader. Okay, I'm out. I've made my money. Well, let me just get my clue and my signals from the market that we're going to go down. And we got several. This is a 15-minute chart, and I wish I could just kind of make this bigger. I hope you can see it. That we started to come off. My first and second, here's another thing we add. The ability to read the candlesticks. Candlesticks and where things open and close, that has a meaning to the market. It has a meaning to what you can look for next. But you got the body of the candles. There was the bottom, there was the top. That was a sell. But then it came down, and then it came all the way down. But you see what it did? It produced, and you can't basically see it, but there's a large tail, we called it. And this was a bullish tail, a bottoming tail. But it came up, the bar closed, the bar changed, and it just went down. So you had a lot of people jumping in and buying it right there. And then the next algorithm just came and took it. So if you can act quick, if you got long on that, you better be able to reverse and get out, because when it went very quickly. This is a 15-minute bar. And if I can go over and look, no, because it's on a different screen, but here it is on the 5-minute bar. So the strength, so 15-minute bar started up a little bit higher, like here, but the 5-minute bar kicked in way down here at 18, but look how far it went. But you got a sell. That one maybe you covered, but it didn't. You re-entered. Now you're short again. Maybe you covered here. It ran up, but you entered again. So you could have 3 or 4 separate entries just by following the technique, following what's going on, excuse me, in the market. And you can see the sellers coming in because I'm watching the tick, which is the New York, the tick ND, which is the NASDAQ, and the tick RL, which is the Russell. So again, I trade the NASDAQ, but there are overlapping stocks in the Dow that are also in the NASDAQ. There are overlapping stocks in the Russell that are also in the NASDAQ. So when you see them coming in, selling all of it, get out of the way. Now, what we get, because the NASDAQ can be very thin, is it'll just pop. And what happens? Well, the other thing that I add and have an understanding about is each one of these stocks has a weighting in this index. And it's a cap weighted index. So What is the value of the company? Who sits up at the top of that right now? Microsoft. Microsoft is the most valuable company we got. NVIDIA would like to be, and they almost were for a day or two, but they fell off because they didn't hang out up there. Apple is number two. Apple held top position for a long, long time and may gain it back after earnings. Microsoft may maintain it after earnings. Who knows? I mean, even Tesla's been up there. So again, cap weighted index. So when I see them coming in and you see this pop, I'll go over, take a quick look. Oh, they just moved Apple 50 cents. And I kid you not, they move Apple 50 cents. And if nothing else is happening, this index will jump $6, $7, $8, $9. $9. Because of the heaviness of the amount, the percentage of what Apple does and how it translates into the index. And every time one of the 102 stocks, or it's actually 100, but there's a couple extra, ticks one way or the other, the index is recalculated. And there are algorithms that will buy and sell just the index. So they're taking whatever this calculation turns into, and it gets changed and gets delivered here, the market will move very quickly. And it's just all algorithmically driven. Big change to how things trade. Now, what changes have I had to make in doing Elliott and presenting Elliott and understanding fibs? First of all, fibs can be very, very accurate. Why? Because firms that use Fibonacci, that's exactly what they're doing. They're programming that in. So you will find often a market will get to a level, stop, and reverse. You're like, wow, that was pretty impressive. But it's because the algorithms were done. They had the clue. Now we're just selling. Look at that. Look at that. You see, you can see it coming in. So you had more sells here. And you maybe hang in there, but you can get out because you see how quickly they'll try to bounce it back. And what happens is we got the buy orders coming in somewhere. Every time something gets bought here in the 100 stocks within this index, it changes and is recalculated. Now, we might get another round of selling, which we are, and it'll drive it back down because they're hitting the bid. This is all extremely tradable. And now I'm hoping that you're seeing how fast it can be. And your opportunities are large. So what I'm really kind of laying out here is that we provide within the trade room, and I provide a fairly detailed picture on YouTube each day for the S&P and for the NASDAQ. And now what my plan is, it's like I want to really address that to day traders, because I want them to understand. It's like, boy, you may be having trouble reading the market, but with some other really solid technical analysis using indicators, telling you how we use these indicators. What does the point of control mean? What does value or high and low mean? What makes them shift? What moving averages are you using? What does VWAP mean? What is anchored VWAP? You're getting a lot of people talk about that within these presentations that we're giving. And some of the changes that I've seen within Elliott are due to how algorithms move. But the changes are coming in not so much on the ground breaking. So in other words, there's certain rules that you just do not break. One is that 4 overlaps wave 1. That's a rule. Don't break it. If you do, you've got the wrong count going. And that's where you could get caught up and create some problems. Extensions. There are some times when it just doesn't look right, but it might be the only thing you could do. I'm seeing a lot more diagonals, which are just sets of 3 waves within a 5-wave move. And the diagonal means that it's forming a triangle. So it's running to a peak or it's dropping to its endpoint, and it's wedging as it happens. So I'm seeing more of those. This to me is a little bit of a strange pattern um, because of how it's happening all inside of there. And oh, you can't see it. Let me do this. Quickly bring it over here. Sorry. And oops, because you're unable to see inside on the 1 hour, but I can see inside here. These are very strange little moves. Like this one is kind of good. There's a 3, then this was a 3, then we get a 5, then we get a 3, then we get a 5, then we get a decline in a 3. Then we get very messy. This was yesterday. I mean, this is today, actually. 3 up. That overlapped that, so you can't do it. That leaves that as 3. This is like an irregular, but it's a 3 down. And then we get this going back up. So is that an A, a B, and a C? Probably. Could it have completed it? Yeah, it could, but I've got to add it to all the rest. So if I stand back and I add it, then there's a very fair chance that this high completed that 4th wave. I'm not there yet, but it could have. But it could have. So my favorite indicators help me a great deal. Elliott is present on a 5-minute chart, on a 2-minute chart, on a 15-minute chart. Why? Because they're building blocks. Elliott wave is a building block. You start with a simple 5 waves. You finish 5 waves in either direction, then you do 3 waves after, which would be the correction. That's a complete move. But what essentially, if you're just brand new and you're just starting this count, it produces the first and the second wave of 1 degree. And now you're ready to move into a 3rd wave. What's going to be inside that 3rd wave? 5 more waves of 1 lesser degree. So if you understand the pattern and you understand what is consistent within it, then you can pick up the other things, the characteristics, the personalities of these waves. And trust me, they all have personalities. And they could be craziness, it could be like flipping all over the place, and that's more of a corrective type of a move. Trading in a box, trading in a limited area, that's more corrective. When you're impulsing, you're doing exactly that. Impulse comes in 2 ways, folks, up or down. You can impulse down, you can impulse up. And you'll see them. This was an impulse down. Now, what we could be doing, we're even getting closer. I'm going to tell you in 2 minutes, expect something big to happen in this market. There's one player. I call him the 350 guy. Other people call him other things. But every single day, he's always got something to do. He's either going to buy it or he's going to sell it. But he's always got something to do. And I would think, I'm not really sure, but I kind of am leaning towards he might be a seller today because I see how it started. But here they come. Buy them, buy them, buy them, buy them. But he'll show up with a large amount. And that's going to happen in about 1 minute and 10 seconds. So let me just go over here because I know some people are maybe asking someone. Soho. No, day trading does not require larger positions to get a reasonable return. That's not true. I can trade 1 lots and make $500. Oh, the algo Soho. Oh, thank you, sir. Thank you. I still call him the 350 guy, but there you go. But thank you. Interesting. I never knew that. Thank you very much for sharing, Tim. I appreciate that. But to get back to, hey, Ryan, who got it? But day trading requires larger positions to get a reasonable return. And that's not true. You can trade 1 lot. You can make decent money trading micros, which instead of being $5 a tick or 50 cents a tick. You get a big enough move and it'll go. Now the 350 guy came out and he was nothing. Pushed it up a little bit. Okay. unless that's him kind of putting them through now. Um, so I, yeah, okay. I'm just catching up on my questions. So here's what I want to talk about as well to kind of close this out. Making some adjustments to the trade room. Um, Sasha, who's actually here listening, um, he and I run the trade room, and we each present. I do more of like a little bit bigger. I go to the hourly and bring it down, and then Sasha really fills in a lot of blanks. Again, I want to tell you, this is someone who has picked up Elliott masterfully, understands these algorithms, understands Fibonacci, understands candlesticks very, very well. So what we're adding is breakpoints. What happens if it breaks? If it moves through here, look for it to go gather all the whatever it's doing, because that's where the stack of orders are. But then we'll be paying very close attention to what comes next. And that happens on both sides, buyers, sellers, both sides. We're able to give you more information on what the pattern looks like and what to expect from the pattern. We are able to give you information on the candlestick pattern and understanding that this usually is what presents or comes after this. Or if a market breaks this level, comes back and tests here, we're looking for it to go resume. So there are a lot of things that we can add that are at the moment. So you're adding them as the market is trading. So, and what does that do? That's to everybody's advantage, because we trade more. We're also able to tell you, it's like, we're not touching it, folks. It's too choppy, too sideways, too, nobody knows really what they're going to do. They're just, I call it, they're throwing spaghetti at the wall and seeing what sticks. So everybody's like throwing their orders out there because that's what they have to do because they've scheduled them. But the market is like whipping all over the place. You don't want to get caught up in that. And I want to tell you from personal experience, you can get caught up in that thing like, oh, it's going to flip, it's going to go back, it'll turn. Next thing you know, you're down 1,600, 1,700, 1,800, 2,000, 2,500, and you still have not finished the first 2-minute candle. Now that's truth. So we want to try to prevent that. So we help people determine and develop a little bit of a trading strategy for themselves. Now, yes, you know, when you I'm just going to keep going that day trading requires larger positions to get a reasonable return. That is just not true. That is absolutely not true. Not in this future. Not even in the S&P. Maybe in others, but in the Nasdaq and the S&P, absolutely not. You don't have to have a larger position. You'll make a lot more if you're able to trade a 5 lot. But again, it just really goes to what your account size may be. I will give you that. I will say that, but there are different things that you can do that will help you get greater funding if that's your interest, um, or just be able to trade with the amount that you're starting with. So I and what your mental abilities can handle. Um, I guess, yeah, that would be true. What your mental, yeah. But we also work on that. Thank you, Tim, for adding that, because um, your what happens inside your head is either going to be supportive or it's going to destroy you. Yes, emotional ability is when you jump side. Yes, absolutely. Your heart goes, everything else goes. It's true. But if you understand some things and you can go through and take an honest look at yourself, another thing that I present to the trade room, not so much every day, but I probably should just be bringing it up more, is what I call an SET score. And if any of you have ever heard my friend Rich Friesen, he and I, plus a couple of other people, came up with this sensations, emotions, and thoughts. And what we're doing is we give it a score. So each day before you start trading, you're taking a look at those. I love this selling. This is all opportunity. But you give those a look. What are your sensations? What are you feeling? What are your emotions? How is that happening? And then what are your thoughts? And if you're scoring low in all of them, you get to make a choice. Do I really want to trade? Because you're right. What Tim has presented and saying, and what your mental abilities can handle, that's truth. That's truth. So I need to wrap this up. What I want to say is if you would have an interest in joining a trade room that day trades, and again, right now we're a lot of our focus is the NASDAQ, but we offer out the S&P, or maybe there's another market that you trade, we'd be able to bring that into the fold as well. We are changing how we want to present. So I'm going to be taking my in-depth daily and moving it over to our Discord server and our Discord room. And we're looking for day traders that have an interest in making money. Now, the normal cost of our day trade, our trade group is $299 a month. But here's what I always say is that I attempt to make $300 a day. And I try to do that in the trade room so that you all can follow my trades. And if I'm making $300 a day, you're paying for that trade room on day one. Everything past that is gravy, so to speak. So it's not like it's this great expense. Number two, I don't automatically bill each month. You get the choice. It's like if all you want is that 1 month and it's not going to be for you, that's your total commitment. You don't just continually get billed. But we want to offer out for the first month for people, whether you come in now or 2 weeks from now, I'll offer you the first month for $200 and help you make that $200 on your first day. Pay for the room and then stick with it and just go forward and make money. And I'll help, Sasha and I both will help you develop your trade rules, how to put a stop in, what you need to do with the stop, what you got to do. So we do all of these things because we like to see people become successful. There are too many times it's like you try, it gets emotional, and you don't have anywhere to turn. So we got a lot going on. And so I want to say, please, if you have an interest, contact me. It's Michael at mjf1partners.com. Send me an email. I will help you out. My webmaster is in between a huge move of moving her home and her farm from Texas to Indiana. So my website is not necessarily set up, but you can go onto my website and you can join the trade room. No problem. And you would find that at tradershelpingtraders.com. And then there's a tab called the trade room. And you can just go in there. Should you decide this is something you have to do and you go and you do it, please go ahead. I will refund you the $99. No problem. Even before you get, how do you get into the trade room? I would immediately just refund you that money if you're interested in coming in now. If not, you can come to me and state your interest, and I will make arrangements with you so that you're on for $200. And I'm going to end right there because I know David's need to kind of come in and finish this up. Thank you so much, David. And thank you everybody else for hanging out with me. And I know I talk a lot and I talk fast.